Welcome to Celebrity Investing, your go-to source for insights, tips, and updates on navigating the exciting landscape of personal and global finance. Please like, share, and subscribe for more exclusive content. This is part 2 of Unlocking the World of Swaps, a comprehensive guide for 2024. Hedging risk. Swaps serve as an effective tool for hedging financial risks. By locking in interest rates or currency values, they help protect against market fluctuations. For example, a company with a variable rate loan might enter into an interest rate swap to pay a fixed rate. This locks in payments and shields the company from rising interest rates. Here's how swaps can help hedge risks. Stability. Fixed payments provide certainty, making budgeting more manageable. Protection from volatility. Swaps can help avoid unexpected costs caused by market swings. Customized solutions. Companies can tailor swaps to meet their specific risk profiles. Imagine you're a business owner facing unpredictable costs. Swaps allow you to safeguard your finances, letting you focus on growth rather than worrying about interest rates. Enhancing cash flow management. Effective cash flow management is crucial for any business. Swaps can help improve cash flows by aligning payments with revenue streams. For instance, a company expecting income from fixed contracts may benefit from a swap that converts variable payments into fixed ones. Here are some ways swaps enhance cash flow management. Smoothing payments. Swaps can standardize outgoing cash flows, making expenses predictable. Aligning cash flows with business cycles. Companies can adjust payment schedules to match their income patterns. Strategic financial planning. Businesses gain flexibility to reinvest or allocate funds more effectively. Consider a scenario where your business experiences seasonal sales. Using swaps allows you to balance out cash flows across the year, ensuring you can cover expenses when sales are low. Swaps can transform how companies and investors manage financial strategies. They not only mitigate risks but also streamline cash flow processes. What cash flow challenges do you face that swaps could help solve? Risks involved in swaps. While swaps can be valuable tools for managing financial risk, they come with their own set of challenges. Understanding these risks is essential to making informed decisions. Here, we'll discuss 2 main types of risks associated with swaps: counterparty risk and market risk. Counterparty risk. Counterparty risk refers to the possibility that one party in a swap agreement may fail to fulfill its obligations. This risk can arise from financial instability, loss of creditworthiness, or similar issues. If a counterparty defaults, the other party may face significant financial losses. Imagine entering a swap agreement with a company. If that company goes bankrupt or struggles to meet its commitments, you could miss out on expected cash flows. Here are key points about counterparty risk. Financial stability. Assess the financial health of your swap partner. Check credit ratings and financial statements before agreeing to terms. Diversification. Avoid concentrating swaps with a single counterparty. Spreading risk across multiple partners can reduce the impact of a default. Usage of collateral. Consider requiring collateral to mitigate potential losses from a default. This could provide a safety net if things go wrong. Always ask yourself, how reliable is my swap partner? Taking the time to assess potential risks can save you from future headaches. Market risk. Market risk involves potential losses due to fluctuations in interest rates or currency values. This risk can impact the cash flows involved in a swap agreement. Changes in market conditions can affect the value of a swap and the expected payments. For example, if market interest rates rise significantly after entering an interest rate swap, your fixed rate payment may become less favorable. Here are the main aspects of market risk to consider. Interest rate fluctuations. Keep an eye on market trends. Rising interest rates can lead to higher costs if you're locked into a fixed rate. Currency exchange variability. In currency swaps, currency value fluctuations can affect cash flows. Changes in exchange rates could result in losses. Economic conditions. Global and local economic changes can impact financial instruments. Be aware of economic indicators that might signal shifts in the market. Ask yourself, how do current market conditions affect my swap agreements? Staying informed can help you adapt your strategies to mitigate market risk. Recognizing these risks is crucial in swap agreements. By evaluating counterparty and market risks, you can make better informed decisions and protect your financial interests. What steps will you take to reduce these risks in your own swap activities? Regulatory environment surrounding swaps. The regulatory environment surrounding swaps has evolved significantly, particularly in response to recent financial crises. Understanding these regulations is crucial for anyone involved in swap transactions. This section will explore the major changes in regulations and highlight specific provisions of the Dodd-Frank Act that directly impact swaps. Post-financial crisis regulations. After the financial crisis of 2007-2008, regulators recognized the need for stricter oversight of swap markets. The aim was to increase transparency and reduce systemic risk. Here are some major regulatory developments. Increased reporting requirements. Swap transactions must be reported to trade repositories. This allows regulators to monitor market activity and assess risks in real time. Central clearing mandate. Many swaps, particularly interest rate swaps, now need to be cleared through central counterparties, CCPs. This reduces counterparty risk by ensuring that a neutral party manages the transaction. Higher capital requirements. Financial institutions engaging in swap transactions face stricter capital requirements. This ensures that they can withstand potential losses, promoting overall market stability. Enhanced risk management practices. Regulators now expect firms to establish stronger risk management frameworks. This includes stress testing and ongoing assessment of swap exposures. These changes reflect a broader commitment to prevent another crisis. They promote a stable environment for swap transactions, ensuring that organizations can manage their risks effectively. How do these regulations influence your approach to swaps? Dodd-Frank Act implications. Passed in 2010, the Dodd-Frank Wall Street Reform and Consumer Protection Act brought sweeping changes to the financial industry, especially for swaps. Here are several key provisions affecting swap transactions. Mandatory clearing. Dodd-Frank requires certain classes of swaps to be cleared through CCPs. This measure aims to lower systemic risk by providing greater oversight. Swap dealer registration. Organizations involved in swap dealing must register with the Commodity Futures Trading Commission, CFTC, or the Securities and Exchange Commission, SEC. This registration process includes compliance with various rules, including capital and margin requirements. End-user exemption. Some non-financial companies can avoid mandatory clearing if they use swaps to hedge commercial risk. This exemption allows businesses to manage their exposures while still maintaining some flexibility. Increased transparency. The Act promotes transparency in swap markets, with requirements for swap data repositories and public reporting. This aids in monitoring market trends and identifying potential risks. The Dodd-Frank Act fundamentally changed how swap transactions are conducted. It aimed to minimize risks and improve market integrity. As regulations continue to evolve, staying informed is essential. How do the Dodd-Frank provisions affect your understanding of swap transactions? Future trends in swap markets. As swap markets continue to evolve, it's essential to recognize trends that shape how these financial instruments operate. The integration of technology, along with the rising importance of environmental, social, and governance (ESG) factors, plays a key role in this transformation. Let's dive into these developments. Technology and innovation. Technology is revolutionizing swap agreements, making them more efficient and accessible. Advanced systems streamline processes and enhance transparency. Here are some notable impacts of technology on swap markets. Automation. Workflow automation reduces manual tasks. This leads to faster execution of swaps and fewer errors. Data analytics. Better data analysis helps firms understand market trends. It allows for smarter decision-making in swap trading. Blockchain. This technology offers secure and transparent transaction records. It could simplify the clearing and settlement process. Digital platforms. Online trading platforms provide easier access to swap markets. Investors can trade more freely without the need for traditional intermediaries. These advances can empower players in the swap market, making transactions more user-friendly and efficient. Are you ready to take advantage of these technologies in your swap strategies? Stay tuned and continue to watch our videos to gain valuable insights into the world of finance. Subscribe, like, and share to continue your journey to financial success.